Although some common tax features apply in most countries, each jurisdiction has its own unique corporate tax code, and therefore a thorough understanding of the tax laws and regulations help develop an optimal tax management strategy and plan, as tax management should work to enhance the corporate strategy while at the same time tax minimizing transactions should not deter the company from its strategic plan. In this sense, optimal tax planning does not mean that business operations should be allowed to be significantly affected only to be eligible for tax breaks. It does, however, attempt to minimize the tax burden for the corporation, and therefore it is integral to the financial planning process. The golden rule in tax planning for corporations is to comply with the tax code where corporations are established and in countries where they operate, and to file and pay all related taxes accurately and on time. By that they avoid paying more taxes in the form of penalties. Tax planning should anticipate potential changes in the tax codes, and attempt to incorporate tangible changes into tax planning. It can add value by deferring or decreasing tax payments using alternative accounting techniques. Effective tax planning involves negotiating tax benefits with tax authorities as well as counterparties. Tax management also includes transforming certain types of income into gains, certain types of expenses into losses, and certain types of taxable income into non-taxable income. Tax strategies are usually based on taking advantage of time value of money, paying taxes later, or differences in tax rates. Tax rate arbitrage. In tax arbitrage, accounting entries are used to shift profits to jurisdictions that impose the lowest net taxes. Tax savings strategies usually fall into four types: creation, conversion, shifting, and splitting. Creation involves plans that take advantage of tax subsidies, such as moving operations to a jurisdiction that imposes lower taxes. Conversion entails changing operations so that more tax-favored categories of income or assets are produced. Shifting involves techniques that move amounts being taxed to more favorable tax accounting periods. For example, accelerated depreciation, which allows more of an asset's cost to be a tax-deductible expense in the early years, thus deferring the payment of taxes on that asset until later. Splitting techniques entail spreading the tax base among two or more taxpayers to take advantage of differing tax rates. More on tax planning in the following video.